Okay, we are in week 14 of the semester, and we're going to take everything that we've learned thus far and put it into estate planning. We know about trusts, we know about wills, we know all the different things we can do with trusts generally, and we know that there are taxes associated with your estate when you die. And we know we don't want to have to pay taxes 2-3 times on things that we've already paid taxes on when we're alive. We also know we don't want to saddle the people we've left behind with potential taxes, specifically spouses. So what do we do? First of all, we set things up so that we set goals for what we want done with what we have when we die. Do you like your kids? Do you not like your kids? Do you want to give everything to your kids? Do you want to give some stuff to charity? You have to set your goals before you even begin. Then you have to see how you can accomplish those goals. Now, let's just start at the beginning by saying, I'm pretty old. 20 years ago, my goals were different from what they were 10 years ago, and they're different today. What's my point of me telling you that? You have to periodically review your estate planning. Your kids grow up. Maybe, you do your last will and testament when your kids are minors. So you have different goals from when they're in their 40s. So along the way, you have to periodically review what you've done, review what your assets and liabilities are and what's going to go into the estate, because that's going to change too. Wouldn't it be nice if everything just sort of stayed still? But it doesn't. And so you periodically have to look things over. I'll tell you, every January 1st, that's what I do. Kids make fun of me. I make sure everybody gets their donut. I make sure everybody has a good breakfast, does what they want to do. And I, in my pajamas, probably too much information, go and sit. And I look through our estate planning. And I have a standing appointment with my attorney. I don't do this myself. And it's not my brother because he's an interested party. I have my own probate attorney that I do estate planning with. And I have a standing appointment for the third Thursday of every January where we sit down and we go through changes. And there are always changes. Nothing stays the same. Okay? So that is your first thing that you need to know. What I know my brother, for his clients, sends out a little postcard, little letter, an email around Thanksgiving every year. It says, hey, it's time to start looking at reviewing what you've got. If you've got any changes, come in. And his busiest time of year is January and February, because people do that. They'll look over what they've done. And, the holidays are crazy. Everybody's busy. So January 1st, when everything is sort of settling down, they kind of look at their stuff and make their appointments. In January, February, he is busy reviewing. When you have your estate planning, you have to take into account taxes. And, again, I'll say it again. There are people in government that will tell you it is your patriotic duty to pay as many taxes as you wish. And my first question is, how many deductions did you take last year? Did you take every deduction you possibly could? Did you minimize the taxes that you had to pay? And they all say, oh yeah, but it was all legal. So, yeah, don't tell me I've got to pay a bunch. I've already paid taxes on all of this stuff. I'm not going to pay taxes again if I don't have to. There are a federal gift and estate taxes that you have to take into account. There are state death taxes you have to take into account. Death taxes or estate taxes. There are administration expenses, court costs, cost of getting appraisals, cost for your administrator or your executor. They have to take into account. You have to take into account that your executor, to pay your debts, if you've got a lot of debts, may have to liquidate some things that you wanted to give to people just to pay your debts. So you better keep that in mind too. If you are an employer of people, you have to take into account the people who work for you when you die. That's your ethical obligation. Okay? What do we need to develop an estate plan? Well, we need to know about wills and trusts, which you know. We need to know about the marital and charitable deduction. We'll talk about that. We'll talk about estate tax saving devices that will reduce the amount of tax that's charged on your estate. The bigger your estate, the bigger the percentage that you're going to have to pay. I'm not going to talk about powers of appointment, even though your book does. Honestly, that's a really convoluted kind of thing. We're not going to talk about that. And then we have trusts and we have life insurance. So let's go through these, okay? We know about wills, we know about trusts, okay? I'm not going to spend time on those. Let's talk about the marital deduction, okay? If I want to reduce the amount of federal estate tax that I have to pay, and I'm married, I'm going to leave everything to my husband, because there's no estate tax on anything that I leave 100% to my husband. Same here, okay? And then the one that survives, we're going to set up a trust. And that trust can be, it's usually called a bypass trust. It could be a Q-tip trust. It could be a bypass trust. So that the surviving spouse is going to get income. And then when the surviving spouse dies, everything passes through the trust to beneficiaries. Sounds like a pretty neat bypass kind of thing, right? I'm sending everything to my spouse, and my spouse will have income till the day he or she dies. And then when they die, everything's going to go into everything that's in the trust is going to go to my kids or whoever I want it to go to. Okay? We want to make sure that your surviving spouse has income to live on for the rest of their lives. You want to make sure that you can avoid paying taxes because that cuts into what your spouse can survive on for the rest of their lives, right? Okay, and we're going to talk about Q-tip trusts and we're going to talk about bypass trusts in a little bit. Keep that keep in the back of your mind, okay? Another kind of way we can reduce the value of our estate is by charitable deductions. We've talked about that, right? We can reduce the amount that that our estate has to pay by giving some to a charity, and then that reduces the amount of money that's in your trust. Now you can do it different ways. You can do a remainder trust where anything that's left over goes into trust for a charitable trust for whatever charity. You can do a charitable remainder unitrust. What? Where the settlor will put cash or property into a trust, and not less than 5% of the fair market value of the property in the trust will go to a non-charitable beneficiary, and then the charitable income will go to the charity. So what am I doing? I am basically saying that for the life of my beneficiary, they get a percentage of this trust, and then when they die, you get the whole thing. Okay? A charitable remainder annuity trust is a similar idea where my beneficiary will get a certain amount of money every year, and then when they die, everything goes to the charity. The tax ramifications of all of this I can't I can't minimize. You need a tax attorney or a good estate accountant working with your probate attorney, making sure that all of this flushes out. Okay? There are some other things you can do that reduce the amount of your gross estate. You can give gifts during your lifetime that are tax-free for the person getting the gift. You can do trusts that qualify for the marital deduction. Those are those Q-tip and bypass trusts. And you can have life insurance. Powers of appointment are in there. Again, I'm not even going to worry about those. Okay? So you can make a gift of up to $14,000 to somebody without there being any kind of effect on their taxes. Beginning in 2013, they did that. This dollar amount changes regularly, and so before you give gifts in anticipation of death, you want to make sure that that you're meeting the requirement so that there's no tax benefit, no tax liability for the recipient. Okay? You can give gifts of future interests in things. That becomes a little bit more difficult, but you can do that. And then there are these trusts that qualify for the marital deduction. Okay? The most popular are these Q-tips, qualified terminable interest property trusts. Okay? And the way a Q-tip trust qualifies as a marital deduction is it's given to the surviving spouse all the right to the income from trust property for life, payable at least annually. And it gives the surviving spouse the right to use the trust property to live in the family house, vacation home, whatever. And it does not allow any person, including the surviving spouse, to have any power to appoint any part of the property to any person other than the surviving spouse for the spouse's lifetime. So, as part of a Q-tip trust, my spouse can live in our marital home forever but can't sell it. Otherwise, it violates the Q-tip portion and there are some tax ramifications. Okay? A bypass trust is also called an AB trust. So with a bypass trust, it's similar to a Q-tip trust, but you are transferring everything to the spouse, and then the spouse transfers everything to a qualified interest to beneficiaries. Okay? Another thing that you wouldn't think would affect an estate is life insurance, right? I would think if I have life insurance, then it's not part of my estate, right? If you have term life insurance, it is. But if you have cash value life insurance or universal life insurance or whole life insurance, it's a little bit different. If you retain any part of ownership or decision making with your insurance policy, it becomes part of your estate. So if you retain the right to change beneficiaries, if you maintain the right to change how the payout goes, then it's going to be part of your estate. And the way to avoid that is to do a life insurance trust. Now, that's kind of a big deal because a lot of people don't realize that life insurance, if you retain the right to change the beneficiary, your insurance proceeds are going to be added to your estate, which is going to increase the value of your estate. If you have a $100,000 policy or $1 million policy, you have now jumped the value of your estate and increased the amount of taxes that are going to be owed. And those life insurance policies are going to be used for something other than what you had hoped they would be used for, which was for the people that you left the money to. Okay? So there is an irrevocable trust illustration on page 506 of your text. And in that you can see that what happens is the settlor annually gives money to a trustee in trust, and then the trust is the owner of the insurance policy. Then the trustee annually gives written notice of the gift and the right to elect by the beneficiaries of the trust. The beneficiaries refuse the gift. The trustee uses the gift to pay the premium, and then when the settlor dies, the face amount of the policy is paid to the trust and the trustee distributes it. I know that sounds roundabout, but it is a way to make sure that that your life insurance proceeds are not taxed upon your death. And they're actually going to your beneficiaries. Lots of times life insurance policies are used for burial expenses. We've talked about that. If you don't retain any ownership over the life insurance policy and make the make the funeral home the owner of the policy, you give the money, you have created that trust. Okay, and then the money goes directly to the to the funeral home. Okay. All right, we're going to leave it there. This is a really complex area of law. You have to know tax law. You have to. If you don't, you're doing the wrong thing. If you have you and their spouse, two people who are married, in your office at the same time, you can only represent one of them. And so there are a lot of ethical issues that go with that. And it's really important that an attorney make sure that they know what the goal of their client is and then work backwards, and then uses all of the tools in the toolbox here to accomplish the goal. And that's going to change every year. I know it's hard to imagine, but it is going to change every year. So keep that in mind. Okay, there are a few review questions for this chapter. Again, this is a very complicated area of law. I'm just hitting the high points for you. Okay, do your assignments in your discussion. Any questions, please get a hold of me.